Well, good morning if you're in the UK, and good afternoon if you're in Australia. Welcome to Living the Transatlantic Lifestyle. It's a webinar about, I guess, the relationship between the two countries, Australia and the UK, and how to set up a lifestyle, either moving to or from, or splitting your time between the two. It is in association with the British Australian Society, who are a partner. So we appreciate their support and all their efforts to help us promote that as well. Prince Philip was a patron of the British Australian Society, and as a mark of respect today, we're going to wear dark ties, and may he rest in peace. I'm Stephen Ford. I'm the head of UK financial planning. I will be doing some of the contribution later on in the presentation, and we've got Simon Harvey as well, who's the general manager of BDH Sterling and the owner, or one of the owners. He's also a dual qualified financial planner in both Australia and the UK. And today we've got another guest, Alan Collette, who's the Managing Director of BDH Tax and also a co-owner of BDH Tax. He's a chartered accountant in both Australia and Britain as well. As you can see through the day, we are well positioned, I guess, BDH Sterling as a financial planning organisation and BDH Tax as a tax organisation to support your needs in both these two countries. So somewhat of a one-stop shop for that type of information. The format today will be about 30 minutes, 35 minutes of presentation. It's a weighty topic. There's a lot of detail. It's quite difficult to cover that efficiently, but we'll give you a pretty good summary of main areas that matter. There are a lot of people on the webinar today, so there will be a chance for a question and answer for the final half an hour or so, possibly longer. We will try to answer all your questions. If we can't get there, we apologise in advance, but perhaps send us an email and we'll endeavour to try to mop that up. We'll give you the details to contact us near the end. If you could hold the questions till the end, unless there's some functional problem, perhaps put that in the chat if it's a functional problem. But if it's a question, there's a Q&A button at the top of the screen or somewhere on the screen. If you can put your questions in there, then both Simon and Alan will be gradually reading them once they finish their sections of the presentation, ready to answer them succinctly. If you could put your self on mute, I'll also try to do the same thing, but it just means that if you're double tasking, then we don't hear any background noise. We will share the recording and the PowerPoint. That'll take a couple of days to edit and get out the door, but for those of you who want to replay it, it will be available. It will also be available on YouTube. So without further ado, I'm going to hand over to Alan Collette, who's going to kick off the presentation. Over to you, Alan.
Thank you, Stephen. Thank you, Stephen. Because we've got a relatively short period of time today, I'm going to keep the discussion at a relatively high level. As Stephen said, if you've got any questions, please feel able to send them to us via the Q&A facility or by email. Our email address is on one of the slides at the end of this presentation. So we're going to start by looking at the concepts of residency and domicile, as these drive the basis on which individuals are taxed in the UK and in Australia. Remember, there are different residency rules in each country. There's also a tax treaty between the UK and Australia, which I'll discuss shortly. I then move on to look at how you're taxed if you're living in one country and are working for an employer based in the other. And finally, I'll talk about property income and how capital gains are taxed on the sale of a property in one country if you're living in the other. So starting with the UK. The UK has been using what is called the statutory residency test, or SRT, to determine an individual's residency status since April 2013. The SRT contains a number of provisions. So if you've been present in the UK for 183 or more midnights during a UK tax year, you're automatically a tax resident of the UK. If you've been a resident of the UK in one of the last 3 tax years and are physically in the UK for less than 16 days in a tax year, you're not resident in the UK. We have a flow chart available and you can request that by sending us an email. If you're a resident of the UK and have foreign income, we then look at whether you are domiciled in the UK. Each of us has a domicile of origin, and this is usually where your father was born. You can acquire a domicile of choice in another jurisdiction. You do this by taking steps to sever links with your domicile of origin and demonstrating an intention to reside permanently in a new jurisdiction. If you have a non-UK domicile of origin in the UK and reside in the UK for at least 15 out of 20 years, you will have a deemed domicile in the UK. For those who are domiciled in the UK, your worldwide income and capital gains are properly taxable in the UK, whether or not the income or the proceeds of sale giving rise to the gain are brought to the UK, subject always to the provisions of an applicable tax treaty. If you have a non-UK domicile, you can choose to adopt what is called the remittance basis of taxation. Under the remittance basis, your unremitted income or capital gains are excluded from the charge to UK tax, but you then lose your personal allowance. This said, those with taxable income of more than about £125,000 in the current UK tax year have no personal allowance, as the allowance starts to be tapered away once your income exceeds £100,000. So the loss of the personal allowance by adopting the remittance basis can be of no consequence for those with taxable income of more than over 125,000, as it has already been tapered away to nil. Next slide, please, Stephen. Australia has 4 tests of residency. We'll focus this morning on the 3 tests that affect those who are moving to Australia as migrants, who are returning to Australia, or who are in Australia for an extended period. If any of these tests are satisfied, you're a tax resident of Australia. We start with the resides test. In essence, if you're living in Australia, you are a resident of Australia under the resides test. The Australian Taxation Office advises that these factors are relevant: your physical presence in Australia, your intention and purpose of being in Australia. So a holiday in Australia doesn't cause you to be a tax resident of Australia. Location of other members of your family, business or employment ties, social and living arrangements. The ATO has issued a tax ruling for migrants to Australia. It's tax ruling 98/17, and this further discusses the resides test. The second test, the next test, is the domicile test. If you are domiciled in Australia, the same considerations apply as I've discussed in respect of the UK. You are a resident of Australia for tax purposes unless you have a permanent home that is located outside Australia. And ATO tax ruling IT 2650 discusses this in detail. Permanent in the context of permanent home doesn't mean forever. The typical benchmark is 2 years outside Australia, with a requirement to have a place where you are living with your family and where you sleep at night. Once you're no longer living at such a place, it's probable that your tax residency in Australia will recommence. The third test to consider is the 183-day test. If you're in Australia for more than half the Australian tax year, you will be a tax resident of Australia unless your usual place of abode is outside Australia and you have no intention to take up a residence in Australia. Note that assessing your residency status is a self-assessment. There is a residency tool available on the ATO website if you need help. Next slide, please. Those who are tax resident in Australia are generally subject to Australian income tax on their worldwide income and gains, whether or not it is remitted to Australia. Unlike the UK, Australia does not operate a remittance basis. Income and gains received by residents of Australia are taxed on what is called an arising basis. A valuable exemption from the charge to Australian tax in respect of foreign income and most capital gains on the disposal of investments is available to certain temporary visa holders who are tax residents of Australia. These visa types include provisional visas available to business owners and investors, employer-sponsored visas under subclasses 457 and 482, provisional regional skilled visas, those who are living in Australia as the holders of bridging visas while awaiting decisions on onshore visa applications, with the exception of partner visa applicants, and many New Zealand citizens. Moving on, please, Stephen. As you might expect, the UK and Australia have had a tax treaty in place for many years. Tax treaties are in place to ensure that individuals and businesses are not disadvantaged. For example, they ensure that income is not double taxed. Treaties usually include provisions to allocate taxing rights in respect of various sources of income and provide guidance on where individuals and companies are resident for the purpose of the treaty. So, in the case of the UK-Australia treaty, there are residency tiebreaker provisions. There are also provisions that discuss the taxation of employment income that is paid from one jurisdiction when an employee is tax resident in the other. There are provisions that discuss the taxation of income from a UK pension or from Australian super when the taxpayer is resident in the other country. This is particularly important when the treaty gives sole taxing rights to one jurisdiction, for example, certain employment income and pension income. It's important to note here that even though an individual can be considered to be a resident of, say, the UK under the residency tiebreaker provisions of the treaty, this does not mean that the taxpayer is not also resident in Australia for the purpose of Australia's domestic tax legislation. Next slide, please, Stephen.
Sorry, it's stuck.
Okay, so just a quick recap on some action points regarding your residency. When you are departing or arriving or are going to spend a significant period of time in the UK or Australia, having departed one, living in the other, moving to the other, it's important to review your status. You should understand what this means for the taxation of your income and your capital gains. You should plan the timing of departures and arrivals with care, because timing a departure incorrectly would potentially give rise to additional tax liabilities that can be avoided. And ultimately, take advice if you're not sure about your situation. Moving on. So we're increasingly seeing people living in one country being employed by an employer in another country. The COVID-19 pandemic has hastened a desire to work remotely. And there's an increasing willingness for employers to retain valued team members who are working away from the office. So you might continue to be employed by a UK employer when you are living in Australia. In this situation, are you tax resident in the UK under the statutory residency test? Are you tax resident in Australia under the resides test? What do the residency tiebreaker tests in the treaty say about where you are resident for treaty purposes? These questions are relevant to how and where your salaried income is properly taxed. Clause 1 of Article 14 to the treaty says that salaries, wages, and other similar remuneration derived by a resident of a contracting state, for example, Australia, in respect of an employment shall be taxable only in that state, i.e. in Australia, unless the employment is exercised in the other contracting state. So if an employment is exercised, i.e. performed or undertaken in Australia, the employment is most probably solely taxable in Australia and not in the UK, even though the salary is likely to be taxed under pay-as-you-earn in the UK. There are other clauses in Article 14 that would need to be considered, but the key point to take away here is that becoming a resident of one country while receiving employment income from the other is likely to require a review of your personal tax position and where the income should properly be taxed. Next slide, please, Stephen. So moving on to the taxation of property. As I know some of you have or will have property in one country while you're living in the other. For rental income, the tax treaty between the UK and Australia doesn't give sole taxing rights to one country. Rather, the rental income, after deducting expenses as permitted by each of the UK and Australia, is taxed firstly in the country where the property is located. The net rental income is then taxed again in the country where you are a resident. A tax credit or offset is then claimed in the tax return for the country in which you are a resident for the tax that has been paid in the country where the property is located. Tax returns are likely to be required to be submitted to HMRC and the ATO each year. Some key points to take away here include that you should be aware of the UK's non-resident landlord scheme or NRL scheme if you are letting a UK property and are not a resident. While loan interest for a property purchase is no longer deducted as an expense in the UK, it's given as a tax credit at 20%, the outcome is likely to be the same so long as you are not paying UK income tax at a marginal rate that is higher than 20%. And that is typically the case for those who are not resident in the UK. This means that using a special purpose vehicle to own a let property in the UK is likely to have no financial benefit once you are no longer a tax resident of the UK. You should optimise tax deductions in Australia. The rules for claiming tax deductions in Australia are different to the UK. In Australia, the ability to use rental losses as a tax deduction against other income, including your salaried income, is available. This is known as negative gearing. And tax losses on an Australian property that arise during a period of non-residence in Australia can be tax deducted against income in the year in which your Australian tax residency resumes. So when you become tax resident in Australia, can therefore be key to making best use of rental property losses that have arisen while you're non-resident. Moving on, Stephen. A key driver for the ownership of property is the prospect of capital gains. With time starting to run out on us, I'm going to simply highlight that there can be very different tax outcomes depending on when a property is sold. For example, a UK investment property might be sold when you're resident in the UK and not resident in Australia, or when you're not resident in the UK and have become a resident in Australia. If sold while you're resident in the UK and not resident in Australia, the UK calculation will have reference to the original cost of the property. If sold when you're not resident in the UK and are resident in Australia, the UK calculation can have reference to the value of the property in April 2015, given you owned it at that time. The Australian calculation will have reference to the value of the property at the time you became tax resident in Australia. This offers potentially a rebasing of the property for capital gains tax purposes, and often washes out a significant capital gain from the charge to tax, and can therefore save significant amounts of tax. Moving on, Stephen. So, in summary, regarding property, it's important to understand your tax residency status and the impact of timing on the taxation of property income and capital gains on disposals. You should optimise your tax deductions. Different rules apply in the UK as against Australia. Tax planning. As ever, don't leave it too late. You can't plan after the event. We typically suggest maybe having pro forma illustrative capital gains tax computations prepared where the disposal of a property is in prospect and you're looking at moving between one country and the other. We also suggest considering estate planning, UK inheritance tax, and Australian capital gains tax on death, where an asset is passing from an estate to a non-Australian resident beneficiary. We have a webinar in June, which I hope a few of you will attend in that regard. And that's it from me. Back to you, Stephen.
Thanks, Alan. I will say in our own work of financial planning, we do find the taxation very complicated, and it's easy to take a kind of general view thinking you know what you're doing, but sometimes there's a lot of quirk. So we do recommend speaking to Alan if you've got a hardcore taxation question. Moving on to financial planning, I guess, depending on your stage of life, then retirement income planning becomes a central part of your financial plan. Even if you're a young accumulator in your 30s, there's still worth paying due regard to what retirement income might look like and just how much you need. But I guess there's a lot of questions as you get into your 40s, 50s, even 60s. When and where do you want to retire? What do you want to do in retirement? The notion of just stopping work completely and not doing something seems to be receding. Most people want to stay active for mental and physical reasons and stay involved. So how retirement now looks is very different with remote working. People have the opportunity to work very flexibly. So a lot's changed, but have you thought about that and what exactly might that look like? Indeed, what country might that be in even? Would you be somewhat nomadic? I guess one central question for everybody is how long will the money need to last? So what's your lifestyle? What are going to be perhaps your later life care needs? That means you have to make sure you have set aside enough money for that to happen. I think there's a 25% chance that most or some people will live to 100. So that is quite a significant probability, or at least beyond 75, I should say. So we often do in our planning take into account that you might live to 95 to 100 and make sure that you have sufficient funds to fund your lifestyle through that period. And of course, tick off the objectives you'd like to achieve through retirement, which typically has a higher cost at the front while you're very active, then it settles down for a little while, then perhaps gets a little more expensive when care is needed. So really the answers to these questions are the fundamental framework. Yes, the finances are involved, but really it's choosing your lifestyle and the things that matter to you that we're really designing for, and the money is just a way of achieving it. We use a tool or a process called lifestyle cash flow planning. So that is basically looking at your sources of income. So often when you're working, for example, that will be salary. But later in life, you're going to have to rely a lot more on state pensions and other investment assets for your income. And then, of course, there's your expenses, and that's cast out over the entire period of the balance of your life. And as a couple, for both of you, if you are a couple. And that way we try to look forward to the future commitments you might have. You might have children that are approaching university and need to support them or want to support them in funding university fees. You may be planning a large worldwide trip. There's loads of those opportunities. You might want to buy a holiday home. You may want to downsize in another fashion. So all those things are weighed up, and that helps us assess it and model out all those. And then taking into account your financial priorities, we can basically model those and give a great sense of how things might look and compare, I guess, alternative scenarios. A lot of this helps give you confidence and clarity around whether you're able to tick off a lot of those things you want to achieve in retirement. We have a pretty powerful set of tools in the industry that help you forecast out this. And an example is in the graphs on the right there. So you can see in the top graph there that originally that model suggests when the red appears, that means you've run out of money fundamentally. So in that scenario, I think in the 80s, that person or that couple have started to run out of funds. So, part of the process then is to go, okay, so how can we invest differently? How can we save tax? How can you find a way of perhaps managing your expenses differently so that we can get rid of that? And you can see in the example below that was achieved. And that's, I guess, one of the fundamental purposes of financial planning. It also gives us the opportunity to do what if scenarios. So it could be, and often is a question, do I live in Australia or do I live in the UK? Where am I best to set myself up? You know, if I bought a house in both, can I afford it? Those types of scenarios we can weigh up and understand the impacts of those types of decisions. We always put in inflation, so it helps us understand and make sure that you're guarded against inflation and that your investment returns are at least tracking as much as inflation, if not outpacing them, so that your wealth is growing, but also that you are able to afford a lifestyle and it's not getting away on you. So it's a fundamentally fantastic tool. It's got loads of other outputs other than just cash flow, your net wealth, your inheritance tax situation if you're British, or your cost base. And it can also allow us to do loads of stress testing, we call it, which means we model lots of different scenarios probabilistically just to see what the likelihood is that if things don't work out in the pattern we imagine, such as a bear market in the equities market that isn't going so well, how does that relate to your plan and how does it impact it? So it's a very powerful tool and a great spine process for financial planning. I'm going to hand over to Simon now. He's going to walk you through a number of more specific areas of investment as they relate to your financial plan.
Thanks, Stephen. So the UK and Australian pension regimes are very different, and they work in the reverse of each other, really. In the UK, we get all of our tax breaks in the accumulation phase, so contributions receive tax relief at your highest marginal rate. The funds grow tax-free, and then when you retire, you can access 25% of the fund as a tax-free lump sum, but the remainder provides you with a taxable income stream. If we look at the situation in Australia, contributions are concessionally taxed on the way in. There is tax throughout the accumulation phase, and then when you retire, the fund is available tax-free. So if you've accumulated pension funds in the UK and you move across to Australia in retirement, you get the best of those two systems, so it can work extremely well. If we look at the reverse scenario and moving funds across from Australia to the UK, it's not possible to transfer between the two countries, but there can be some tax efficient withdrawal strategies, as we see on the next slide. So if you spend time in the UK and Australia, it's likely that you will have retirement funds in both places. Your residency will influence the most efficient way to draw on those benefits. Now, if under the double tax treaty, Australia has the taxing rights to your pension income, it will often be beneficial to transfer your UK pension fund to Australia. But there are lots of rules that need to be carefully considered. To transfer your UK pension into the Australian superannuation environment, you'll need to be resident in Australia and at least 55 years of age. The Australian scheme will also need to be recognised by HMRC as a QROPS, which stands for Qualifying Recognised Overseas Pension Scheme. There are caps on the amount that can be transferred into Australia each year, and careful planning is required. It's a complex process, but as well as being tax efficient, it can remove exchange rate risk, allow you to consolidate your funds and help you to simplify your affairs in the long run. Now, going the other way, it's not possible to transfer an Australian super fund into a UK pension. If you do have super and decide that you're going to retire in the UK, you will need to wait until you meet a condition of release to access those benefits. That will generally mean reaching age 60, at which point you can receive the whole fund as a lump sum or regular income. Now, if you're living in the UK, those Australian benefits will be accessible to UK tax, but for those withdrawing their super as a lump sum, you are likely to qualify for something called foreign service relief, which can provide a very useful planning opportunity to withdraw the lump sum in a very tax efficient manner. But that will depend on your specific circumstances. Next slide, please, Stephen. So as Stephen mentioned, as part of the retirement income planning process, we'll need to consider your various sources of income. Unless you're lucky enough to have a defined benefit pension or a guaranteed pension that covers your needs, this will likely involve using your capital held in your super, pension, ISA, and other unwrapped investments to generate an income stream. Developing a flexible income strategy can help you to make use of the allowances that are available to you. In the UK, this includes the personal allowance, dividend allowance, savings allowance, tax-free cash from pensions, and foreign service relief on Australian super, for example. It's also important to consider the sequence in which you draw down on your assets. Now, perversely, it often makes sense to draw on your UK pension last if you're retiring in the UK, because your UK pensions are outside the scope of inheritance tax, whilst other assets may not be. Now, turning to state benefits, a full UK pension will provide you with just over £9,000 per annum for an individual or £18,000 for a couple. You'll need 10 qualifying years to get any entitlement and 35 years to get the full pension. Those who are in the UK or have less than 10 years of contributions should think about making voluntary contributions to make sure that they receive at least the minimum level. Now, if you're living back in Australia, the UK state pension will be frozen once it is in payment. Turning to the Australian age pension, this is means tested. So based on your level of income and assets, you may not qualify for the benefit. The wealthier you are, the less likely you are to get anything. Your country of residence is also a factor in determining eligibility. Now, clearly, it's important to be clear on what you can expect to receive from both countries and to build that into your plan. Moving on, a key element of financial planning is to utilise the tax wrappers that are available to you. That includes ISAs, pensions and trusts in the UK, and superannuation and investment bonds in Australia. Now, what works in one country does not necessarily work in the other. If we take an equity ISA, for example, the ATO would look straight through that ISA wrapper, and so it's essentially inefficient for an Australian resident. And they'd look at the purchase price of that investment with reference to either your arrival or the acquisition date, and with reference to the exchange rate at that time. So holding GBP assets as an Australian resident in unwrapped investments or in wrappers that don't work in Australia, that can start to get messy. There are other wrappers, such as an offshore bond, which can work equally well with both countries. So if you're planning to transition between the two tax regimes, it's crucial really to understand how this will impact your various investment vehicles and how to set yourself up for a successful move. Over to you, Stephen.
So one other area that Alan has mentioned was inheritance tax. So in the UK, that's if you're domiciled, so in other words, you're a Brit or you become deemed domiciled, as Alan described, then you're subject to inheritance tax. And if you die intestate, there's a series of rules, which means you have no will, and it doesn't suggest where you want your assets to go. And there are a series of rules that means that they're divided up amongst usually family and children, but not necessarily in the way that you may really want. So it's important to make a will. Also, the advice I've gotten as an Aussie living in the UK is I also need an Australian will and an English will, just because the laws are different. And if I've got assets in both countries, or sorry, each country, I need to make sure I'm protecting them both. So it's important you have that will in place and get that done, and probably in both jurisdictions. Power of attorney gives the right for somebody to have control over another person's finances. And then there's a second type of power of attorney, which is someone's health. So certainly in the case of finances, if perhaps you are getting older or perhaps you're starting to get an illness, then it's important that someone else has power of attorney to help you make those financial decisions once you're incapacitated. And that's a process that needs to start before, and then when the time is right, is invoked so that can be applied. So that's an important fundamental exercise. Typically, you You choose someone, not perhaps your spouse, because they're a similar age and may have similar health issues, and often pick perhaps a sibling or a trusted advisor of some other kind. So it's a small step. Often we neglect it, but certainly in the context of making sure that your beneficiaries get what you would like them to have. I should mention pensions too. Make sure you filled out who you'd like to pass those to. It's important that that step gets done, and particularly in the context of making sure the inheritance tax is balanced out as best you can. I guess as we draw to a conclusion, you can see that through this, there's quite a bit of complexity. We have tried to keep it relatively straightforward, but there is a lot to consider. And I guess you're really working in 4 tax systems where you've got 2 countries and you're a foreigner or a tax resident, and that can swap in either. So it's quite a complicated situation. And there's a series of changes, I guess, that cause transitional issues. So it can be that you can set yourself up or transfer between the countries, etc. But it is important that you plan for that and that you take professional advice. There are a lot of opportunities that Simon pointed out, for example, and Alan in the property area, but there's also some big negatives if you don't get it right. So we suggest you do get professional help to make sure you are clear on what you're doing. That could be both financial planning with a long-term perspective, and then all the taxation that underpins all that. Support making good, wise, tax-efficient choices. All the plans that are created in for both companies are all bespoke to your needs, particularly financial planning, where we are trying to understand your particular lifestyle and your needs and your family, and make sure that it's all customized to you. I guess the outcome really, and you can sense it in people once you've given them a good plan, is that they have a lot of clarity over what A, they need to do, what things can look like, but B, a lot of confidence usually that they are in a good place. If not, then I guess it at least alerts people early that you may need to take some action if you want to make sure that for the later parts of your life are going to be comfortable. So that brings us to the Q&A section, folks. So if you've had a chance, I see some people have already started the process of adding questions into the Q&A function if you can, and there's a few in the chat. So I'm going to hand over to Simon and Alan, who will share answering those questions in a moment. I'm just going to leave on this screen, if you want to contact anybody in either organization, that's the email address. If you could send it to, if it's a financial planning question, just perhaps your age or ages, if you're a couple, just some sense of your financial plan or retirement plan would just help us get some idea of where you're at. That matters. And then for tax questions, a little bit more detail. So I'm going to hand over to Simon and Alan now to let them try to work through all the questions you might have.
Thanks, Steve. I'll kick off with a couple of questions regarding pensions and superannuation. Someone's observed that there are virtually no CUROP superannuation schemes in Australia that can receive UK pensions. Is that correct? There is only one retail public offer pension fund that's widely available to receive UK pension benefits. However, there is an alternative option, and that is to establish your own self-managed superannuation fund, which can apply to HMRC for CUROP status and allow you to transfer your benefits from the UK. So there are 2 main options, the single retail fund or to establish a self-managed superannuation fund. We've also had a question about whether if you were to draw 100% of your Australian super tax-free whilst resident in Australia, is it taxable if you then move to the UK? Generally, no. If you've received the money and it's in your bank account, then that becomes after-tax money and you can bring that across to the UK as cash. There is one caveat that if you have only been outside of the UK for a very short period of time, say you are in the UK and you move to Australia for a year or so, release the super benefits, then come back to the UK, there are potentially anti-avoidance provisions that will complicate that. So generally you can, but generally you can access the benefits whilst Australian resident without any UK tax repercussions. We've also had a question about powers of attorney, whether they're recognised, power of attorney drawn up in one country is recognised in another. It's a really good question. No, it's the short answer. We've had it where a client has had a power of attorney in Australia, thinks that's sufficient to cater for their needs. But then when they had health issues and we needed to implement something on their UK pension, their Australian power of attorney was not recognised by the UK pension provider. So it's generally best to have both wills. If you've got assets in both countries, it's generally best to have wills and power of attorneys in both jurisdictions.
Shall I take a question, Simon?
Yes, please go ahead, Alan.
Okay, so we've got a question about how to notify the revenue if you're moving permanently to Australia. For many in the UK don't fill in tax returns each year. If that's the case, if you're not filling in a UK tax return, that is achieved by completing a form P85. The form P85 is the form you complete when you're departing the UK to live anywhere in the world. If you are completing a tax return each year under self-assessment in the UK, you would usually appraise the revenue of your departure by completing the residence supplement form SA 109 to the UK tax return. The revenue specifically asks that you don't lodge a form P85 if you are in the self-assessment regime. So UK tax returns typically completed by those who are higher earners, earning more than £100,000 a year, those who have rental property income. If you're already in the self-assessment regime, then you would complete the resident supplement rather than the P85. Australian property held whilst UK resident, if you're on the highest UK tax rate. So if you've got Australian property and you're not a resident of Australia, that property is going to be initially taxed in Australia. As a non-resident, you have no tax-free threshold. You're taxed on the first dollar of income at 32.5 cents in the dollar. So unless you are negatively geared on the Australian property, you're going to pay some tax in Australia. That tax would be creditable against your liability in the UK in the form of a foreign tax credit when you complete the foreign income supplement to your UK self-assessment tax return. If you're negatively geared, the negatively geared deductions that you're claiming in Australia are likely to not be allowable as expenses in the UK. And so you can find yourself accruing rental losses under the Australian tax regime, but actually having to pay some tax on net rental profits when that rental income is included on your UK tax return. The non-resident landlord scheme is for individuals who own property in the UK and who are not themselves resident in the UK. So that's one of the questions in the Q&As.
Can I hand back? Yeah, I've got a question here, Alan, about living and working in the UK. Is it worth setting up super in Australia now when no income tax is being paid in Australia currently? So I assume in this scenario, the individual in question is planning to retire in Australia. Now, if they have surplus cash flow that's available for investment, I would prioritise UK pension contributions as the first port of call, because those contributions would receive tax relief at your highest marginal rate in the UK. But if you have maxed out your UK contributions, you can also make non-concessional contributions in Australia, and that whilst UK resident, and that might make sense because if you leave it too late into your retirement, you're going to be limited to the amount of money you can get into super. And superannuation is the most tax efficient vehicle to hold your wealth as a retiree in Australia. So as I say, I would prioritise UK pensions, but then also consider non-concessional contributions in Australia if you have the means to do both. We've got a question here, Alan, which I think is a good one. If the person is a national of both states, how do the states settle the question of residency by mutual agreement? Any experience of how this works?
In that regard, it would be a submission to the applicable tax authorities. There are procedures for making that request for a ruling, and the two tax authorities will communicate with each other. Yeah. This pertains where the other tiebreaker provisions have been inconclusive. So the residency tiebreaker provisions include a discussion of where do you have a permanent home available, and if you don't have a permanent home available, where is your centre of vital interest, as it's called. If these provisions are inconclusive, the final provision in Article 4 of the treaty talks about by mutual agreement between the tax authorities, and that's what I anticipate the inquirers referring to.
And I guess that gives you some real certainty over your affairs, Alan, which you know, and which country has the taxing rights can make a hugely different outcome to your personal tax situation.
It can in the context of primarily, as I mentioned, the sources of income where the treaty gives sole taxing rights to the jurisdiction where the individual is a resident for treaty purposes. With many types of income, the income is in essence taxable in both countries. The treaty will discuss, as I've mentioned, property. It'll talk about interest income, dividend income. With those types of investment income, it's typically the case that both countries have the right to tax the income. With interest income, for example, often there'll be a 10% withholding tax applied to the interest that's received. So if an individual who's a resident of the UK has money on deposit with an Australian bank, the Australian bank, if they've been suitably advised, will simply withhold tax at 10% from the interest that's paid on the monies on deposit, and that extinguishes the liability to tax in Australia. The 10% that's been deducted is then claimed as a tax credit when that foreign income is included on the UK tax return.
We've got another question here about how Australian super is taxed in the UK when paid to a UK resident. It depends on how the benefits are withdrawn. If they are withdrawn as regular income, that income would be accessible to UK tax. However, if you draw on those benefits as a lump sum and you qualify for foreign service relief, there may be a significant amount of relief available on that lump sum. So I think it's best to get advice on the most tax efficient withdrawal strategy based on your individual circumstances. But it is often possible to repatriate the fund to the UK as a lump sum with minimal UK tax, and then to restructure that capital and invest it in a way that's suitable for someone that is resident in the UK.
There's a question here. Can you be tax resident in both countries at the same time? Yes, you can. The domestic provisions are different between the UK and Australia. So particularly those who spend substantial periods, say you spend 183 days in one country and 182 in the other, it's quite possible that you could be resident in both countries, and then that's where the tax treaty comes into play. to identify under the residency tiebreaker provisions, as we've discussed, which country has the primary taxing rights, or in the case of certain sources of income, which country has the sole taxing rights.
Someone's asked whether they heard me correctly. Is there only one CUROP superannuation fund left in Australia? There is only one public offer CUROP superannuation fund available in Australia. The alternative option is to establish a self-managed superannuation fund, which is your own individual scheme. There are thousands of people that have established self-managed superannuation funds and successfully obtained CUROP status from the UK, and we've done that for a very large number of our clients. That has been the core solution for transferring UK pension funds to Australia since around 2015, when HMRC changed the rules on overseas pension transfers.
There's an observation here. And one of the participants has received a letter from their UK bank. They're living in Australia. This is a really common situation at the moment. The banks in the UK are writing to individuals who might be residing elsewhere in the world. They're asking them for information about their tax identification number, and in the case of Australia, that would be your tax file number. These are purely for the purposes of disclosure. There is an increasing amount of information exchange between the tax authorities. We're seeing communications coming out to individuals who perhaps haven't made known the income derived from one country when they're residing in the other, and there's an increasing information exchange. And these letters that are coming out from the banks are part of that exercise to identify individuals who've got tax issues across the jurisdictions. Yes, if you get a letter from your bank in the UK and you're living in Australia, or vice versa, it's important that you complete those letters, because I've heard that on certain occasions bank accounts are being closed if you don't complete the letter. So important to complete the letter, but also be mindful or think about, am I actually being wholly compliant with my tax affairs? Am I making known all that should be made known to the tax authorities in the jurisdictions?
Someone's asked if they leave the UK to live permanently in Australia, how do they notify the UK tax authorities? Hello, I think the best way to do that is to complete the P85 form, which is available from HMRC, and that notifies HMRC of your intention to cease UK tax residency. Would you have any
that's
other
typically
comment?
the case. Yeah. So as I mentioned, if you're already in the self-assessment regime, or if you're already filling in UK tax returns, the residence supplement, the form SA 109, is usually what is the means by which you'd normally advise the revenue of your cessation of residency. As a practical point there, that the form SA 109 can't be completed through the HM Revenue portal. So many of you may be lodging, if you are lodging UK tax returns yourselves, many will choose to do that using the government gateway, the HM Revenue government gateway. The SA 109 can't be lodged through that means. The only options practically for submitting the residence supplements are send in the paper form by the 31st of October following the end of the year, buy some tax software, or appoint a tax accountant to help you with the submission of your UK tax return. But yeah, P85 is relevant for many, but for those who are in the self-assessment regime already, you wouldn't do the P85, you do it through the tax return submission.
We've got a question about accumulating funds in an ISA. Are these taxable yearly in Australia or seen as capital, i.e. only when sold? If you are in Australia, you can't make additional subscriptions to an ISA if non-UK resident. You can continue to hold existing ISAs, and you will only have an Australian capital gains tax charge when you sell down on those assets. If you are receiving any dividend income or any income from the underlying investments, then those will be accessible in Australia.
Yeah, yeah.
We've got a question about whether there's a minimum amount of funds that you need to have to speak to a financial planner. Would it be best to speak to a tax person or a financial planner about how to manage money investments if you're not sure where you want to live longer term? I'll answer the first part about minimum funds. There is no minimum level of funds required to speak with a financial planner. We offer an initial no obligation meeting, and we'll be happy to discuss your specific circumstances from a financial planning perspective. If through part of that process we determine that you require specialist tax advice, we would then refer you to speak with Alan. And at the end of the initial meeting, we'd also provide you with a quote to prepare a bespoke financial plan. You know, after going through the process of the initial meeting, we'll be able to identify where we can add value to your specific circumstances, and then you can make a decision on whether you wish to proceed. Someone's asked whether it's better to retire in Australia and draw down super, then move to the UK and draw down UK pension assets, or vice versa. That one, I think, is almost impossible to answer without knowing more information about your specific goals. And I always think as well that the tax situation shouldn't determine where you want to retire. We would always take the approach, what do you want to achieve in retirement? What do you want to get out of life? Then we look at your assets, and then we look at how we can make that happen through the financial planning process. Obviously, we make sure that you're not paying any paying more tax than absolutely necessary, but I think it should really come down to your lifestyle goals first and foremost.
I've got a question here. If one partner is below the UK threshold, I assume that's referencing the personal allowance. Can we get their share of the Australian rental income tax refunded here? So I anticipate this is a query from someone who's residing in the UK, and they've got rental property in Australia. And as I mentioned earlier, if you've got a rental profit on an Australian property, you're going to pay tax in Australia because there's no tax-free threshold. There's no personal allowance equivalent in Australia if you're not resident in Australia. So with a rental profit in Australia, you're going to pay some tax in Australia. Unfortunately, the UK revenue is not going to refund you a tax that's been paid to the Australian Taxation Office. I'm afraid that's not going to work. So yeah, you'd bear the Australian tax on the rental profit, and it wouldn't then be creditable or refundable in the UK.
Someone has asked whether there's a sensible Australian savings or investment vehicle which are worth starting whilst resident in the UK. We often, as I mentioned previously, we'd use UK pensions as a savings vehicle for someone, a long-term savings vehicle for someone who is going to move to Australia. If you've got shorter to medium-term goals, offshore bonds can work incredibly well for people that are moving to Australia. Generally would require a kind of a 10-year planning time horizon. And there are also other unwrapped investments that might work well if you've got a shorter investment time horizon. It really comes down to what your investment time horizon is, what the goal associated with that investment is, and that will determine the most appropriate strategy. Someone's asked whether we have any case histories we can discuss where people in Australia have retired in the UK by withdrawing all super before they leave Australia and then investing appropriately before and after they arrive in the UK. Yes, we do this quite often. We have quite a few people that move to Australia and then decide to move back to the UK. If they have reached retirement age in Australia before they move back to the UK, they can access their super as a lump sum. And if they're age 60, that is tax-free in Australia. Then that's brought back to the UK as after-tax money. We can then invest that in vehicles that work well for UK residency. And we use a variety of tax wrappers so that the money is sheltered from UK tax, and we'll invest it into a well-diversified portfolio so that the capital can provide you with an income stream throughout your retirement. If you return to the UK before you have reached the age at which you can access your Australian super, it is more complicated because we'll then need to consider how to withdraw that Australian super within the UK tax regime. But as I mentioned earlier, you'll often qualify for something called foreign service relief, which will limit the amount of tax that you pay on that Australian super. So that's something that scenario of moving back to the UK from Australia is something we're well versed in and can help you to develop an appropriate strategy.
There's a question here about sharing time between both countries, equal time between both countries, and how is inheritance tax liability assessed? So to recap, inheritance tax is a function primarily of what's called your domicile. So if you have a UK domicile, you're subject to inheritance tax on your worldwide estate. If you have a non-UK domicile, you're subject to UK inheritance tax on estate that is located within the UK. So the key question, therefore, is where are you domiciled? And one would need to initially consider whether you've got a domicile of origin that is not in the UK. And then we need to look, if you've got a non-UK domicile, whether you've been resident in the UK for sufficiently long periods as to have acquired a deemed domicile in the UK. It's a detailed consideration of your domicile status and your residency status. If one is looking to acquire a domicile of choice elsewhere in the world, spending significant time in the UK is likely to be prejudicial to an assertion that you've acquired a domicile of choice outside the UK. So if one is looking to put together a strategy to mitigate UK inheritance tax, one would typically be looking to reduce the amount of time that one is spending in the UK and to realise one's UK estate and to get it into a jurisdiction such as Australia, if that's where you're going to live, so that it takes the assets outside the charge to UK IHT.
We've had a few more pension-related questions. Do you have to be resident in Australia to transfer your UK pension over? Strictly speaking, no, but if you transfer to Australia whilst resident in the UK, that transfer would be subject to an overseas transfer charge, which would be 25% of the amount that you transfer. So in practice, it's not advisable to do so. Best is to wait until you have arrived in Australia, and then you won't be faced with the overseas transfer charge. There is, however, an element of Australian tax that would be payable on the transfer after you've arrived, and that's generally 15%. The tax is based on the increase in the value from the date you arrive in Australia to the time of transfer, and the tax is generally 15% of that increase in value from the date of arrival. So generally best to transfer the pension funds soon after your arrival if possible. That's on the proviso you've reached 55 years of age. to do so with the minimal tax. Even paying that 15% tax on the growth in value is still preferable to drawing on the pension fund from the UK over time and throughout retirement, because if you do it that way, the Australian tax office would tax you on that regular UK pension income. So that's why it still generally makes sense to transfer the pension to Australia. Someone's asked, if you transfer your UK pension fund into an Australian QROPS, can you then transfer it to a non-QROPS fund? Yes, you can, but only after a period of time. As part of becoming a QROPS, the Australian fund will have agreed to only permit certain transactions, and transferring from a QROPS fund to a non-QROPS fund could incur something called an unauthorized payment charge. So it is possible to do it under certain circumstances, and really you need to get specific advice on that, I think. Someone's asked, why wouldn't you use the one Australian retail superannuation fund that does have QROP status rather than going to the effort and expense of setting up your SMSF? Yeah, the retail superannuation fund works for a lot of people. It does have a more limited investment range than the SMSF. SMSF would be open architecture and you can hold any permitted investment within it. Whereas if you go with the retail superannuation fund, you would need to pick from their menu of investments. But each have their own place and each work well for certain circumstances.
There's a question here about participants. Presumably specific questions regarding residency domicile, best answered by sending an email. Yes, please. Yes, please do that. Happy to have a look.
We've got a question about someone who has an SMSF that has overseas investments. Will any capital gain be free of Australian tax? So it's the sale of an investment within an Australian super fund. That depends on whether you are in the accumulation phase still, in which case there will be tax on any gains within the fund. But if you've reached retirement and are in pension mode, then any gains within your super fund should be free of Australian tax. We've got a few questions about time frames and length of time people have spent in the UK because of COVID, Alan. Could you just comment on where people have ended up staying in the UK for longer than originally planned, how that will impact their personal tax situation?
Yeah, the revenue is mindful of the people finding themselves stuck in in the UK, and similarly the Australian Taxation Office is similarly cognizant of people who are finding themselves in Australia. I think in short, the statutory residency test provisions are still likely to apply. If one finds oneself in the UK for a longer period than anticipated, one needs to look at the statutory residency tests, and you could well find yourself resident in the UK when perhaps you weren't originally planning to be so. I think that's a question that would need to be answered looking at the specifics of an individual circumstances, but it's quite possible that there are some residency issues arising consequential to an inability to depart because of COVID.
Someone's asked about their UK investments that they hold here in the UK. When they bought them, they had to declare that they weren't resident in another jurisdiction, including Australia specifically. If I move to Australia, will I have to sell these? No, you can generally continue to hold investments once you've changed your residency. I think it just comes down to a question of whether those investment vehicles remain appropriate and whether there would be better structures to hold those investments. But you're certainly not compelled to sell investments. You would have an issue making additional contributions to certain investments, such as an ISA, for example, but you can continue to hold them. Someone's mentioned that they heard the phrase, leaving it too late to transfer all your UK pension to Australian superannuation. Is there a limit on how much can be moved each year? If so, what is the limit? Also, what is the time age limit to transfer a UK pension to Australia? So there's a few different questions there, and the rules on this are quite complex. There is something called the non-concessional contribution limit in Australia, which is the amount of the contributions that you can make each year from after-tax money, and that's $100,000 per annum. But you can bring forward, prior to the age of 65, you can bring forward 2 years of contributions and contribute $300,000 in a single year. And that limit will apply to a certain component within your UK pension fund. There is a component in the UK pension fund that is deemed to be something called applicable fund earnings, and that isn't subject to the limit. So, and I'm getting rather complicated, but what I'm trying to explain is that there is a limit on the amount that can be transferred from the UK fund, but there is also an uncapped element to it as well. For those that have got really large UK pension funds, and they can't transfer them to Australia in a conventional manner, phased non-concessional contributions over a period of a number of years. For those where that strategy won't work, there are also other ways to extract the UK pension fund and repatriate the money to Australia with very little Australian or UK tax. So if you have got a large fund, do speak to us about the strategies that we can use. Once you reach age 65, you can't put more money into super unless you meet a works test, which requires you to be gainfully employed in any year that you wish to make a contribution. And then from age 75, you can't make any further contributions at all. Those limits on the amount that you can put into super are there because the ATO want to limit the amount of money that you can shelter within a superannuation fund because it is so tax efficient for a Australian resident. So those limits are in place so that people are only accumulating retirement funds within super up to a reasonable level.
There's a question about fully franked Australian dividends and are they taxed in the UK? Assuming that you're not, assuming you're either domiciled in the UK or you're non-dom and you're not choosing to adopt the remittance basis, the Australian dividend would be taxable in the UK. There's no credit given for the franking credit. The net dividend is taxed. So the net dividend is what goes on the UK tax return, and it's subject to whatever marginal rate of tax applies in the UK. The dividend allowance in the UK is available to consume, to absorb the Australian dividend in the event that it's available to you. But as a rule, Australian dividends are taxable in the UK.
We've had a couple of questions about the UK state pension and national insurance contributions. Is it possible to obtain eligibility to receive the pension if you're being transferred back to Australia before you've completed 10 years of contributions? Yes, you can apply online for a state pension forecast. That state pension forecast will tell you your current entitlement. And then you can also enter into discussions with the Department of Work and Pensions about making additional voluntary contributions. You can make up to go back and make 6 years of voluntary contributions to improve your record, and you can continue to make voluntary contributions over time after you've moved to Australia. So yeah, the starting point would be to get a state pension forecast online, or by contacting the DWP over the phone, the Department of Work and Pensions. And then once you've got that forecast, you can enter into discussions about making voluntary contributions.
Are we going with a question, Simon? Have we answered most of them, or they're still coming in?
I think we've answered most of them. There are a chunk of, I'm not sure we've covered all of them, but I think the best thing to do is probably for people to, if they still have further questions that haven't been answered today, is that people get in touch with us directly and we can speak to them on an individual basis.
Mm-hmm. Yes, agree.
Okay, well, thanks very much, Simon and Alan, particularly Alan, for joining us on this occasion. Hopefully we'll have Alan more involved on a regular basis. Hopefully you've enjoyed it a great deal. We've got another webinar coming up, as Alan alluded to earlier, in June on estate planning in particular. We will try to keep a stream of topics coming out. If you want more information, you can jump on bdhsterling.com. There's a lot of information on there, and then bdhtax.com. if you want to go and understand more about each organization, and also a lot of content down there that can help guide some of the topics we've been talking about. Also, if you want to join with us on LinkedIn, there'll be other streams of content coming out under individuals' names, etc. And then as a result of perhaps being on this registration, there's an email list that will exist where content's sent out on a regular basis that's topical between financial planning in both countries and a bit of tax in both countries. So thank you very much for your participation. Hopefully you found it a benefit, and we look forward to speaking to you if you have any further needs. Take care and enjoy the rest of your day. Bye.